What's up, everybody? Luis here. Hope you are all having a wonderful day. And today, I have a very special guest. His name is Derek Fujikawa. He's a CPA here in the South Bay, and he is a wealth of knowledge. He's one of my CrossFit buddies and my go-to guy for anything tax related. Derek, thank you so much for coming on, and I'm so happy and excited to have you here.
Great. Thank you for having me on.
Before we start, take a moment and share a little bit about yourself. How long have you been crushing it as a CPA? Where are you from, and why did you choose to get into this field? Just give us basically your 2-minute pitch, so to speak.
Sure. So I joined my father's practice back in 1997. So it's been about 25 years since I've been practicing. I was born here in California, grew up in the Bay Area, mostly Fremont, Morgan Hill, San Jose. Throughout junior high and high school, worked with my father in his practice. So, just started out doing just, clerical and menial stuff. But as I got older, gave me a little bit more responsibility and found that I really liked, working with numbers and working with the people. So I went off to UCSB, got my accounting degree, came back, worked for a small firm for a few years, got my license. And then an opportunity came up where one of my father's colleagues and friends was retiring. And so we decided to buy out his practice, and then and I joined him. And from that point on, we worked together for a good 15 years or so, and then he ultimately retired. And so now I'm working on my own.
That's amazing. So, Derek, what do you like the most about what you do?
Really it's just helping people. When you think about accounting, you just think of numbers normally, right? But really, it's a people business. It's a service business, and I really love working with my clients. And, just giving them that peace of mind and letting them, not have to worry about their tax situation or their accounting situation.
Yep. And seriously, accounting and tax, all this talk is kind of boring. But you know what I really love about you is that you make it very fun. Like, I'm able to talk to you about taxes, and it's not like, oh my God, it's tax. No, it's like you're very upbeat, and it's and I love that. And and I'm sure you've helped a lot of people throughout your career. So can you share a story, some customer that comes to mind or a client that comes to mind where you help them discover something that really made an impact? It can be like a deduction, write-off, or something similar, but something that helped them tremendously.
Sure. I'm kind of going on the real estate theme. I had a client where their parents wanted to gift them their house or a house.
Okay.
And so, these were, retired parents. And the clients, they didn't really intend to sell it. They were going to live in it. So something they were planning to hold for long term. And so we kind of discussed it. Fortunately, they came to me before, they did anything. And in this instance, we were able to kind of go over their whole situation and find that, it didn't really make sense for the parents to gift them the house, because when someone gifts a house to or gifts anything to another person, the basis carries over. And so the parents bought this house, 30, 40 years ago, with them, for very little, in the Bay Area, bought something in the 70s, 80s, could have been, maybe $100,000, and now worth well over $1 million. So, if, and the clients didn't have any intention of selling, but if they did want to sell it, and the parents gifted it to them, then their basis is $100,000. They're going to sell it for, over $1 million and have a substantial gain. Even if they take advantage of the homeowners exemption, they're still going to have quite a bit of taxes to pay on that. Right. So we kind of looked at their situation, and the best thing to do was have the parents hold on to that. And then once, one of the parents passes away, then they pass it on to the child, because at that point, the basis gets stepped up to the current fair market value as of the date of death. And then the client, if they decide to, they can turn around and sell it for no gain, or, if they hold on to it longer, at least they have that much higher basis where they can, substantially minimize their taxes. So, in the long run, it saved them quite a bit in taxes.
Wow. I did not know that.
Sure.
This is amazing. You're already providing value to me. Thank you so much.
Sure.
Derek, I get a lot of questions from realtor partners that I work with, even financial planners, and a lot of my past clients as well. They ask me about the tax benefits of owning a home because they don't fully understand.
Sure.
So I pulled up a few of these questions that were asked throughout the last 3 months.
Okay.
And I'm really hoping you can help me with this. All right. I'm
Sure.
going to jump right into it. First one, let me see. Where is it? First one is very simple. I get this a lot. What is the tax benefit of owning a home?
Sure. Sure. So, um, the biggest one is the deductions, right? You get the mortgage interest and property taxes that you can deduct. So that's kind of right off the top there. You get those. The second one is, if it's your primary residence, you get this 500, or I'm sorry, you get a $250,000 exclusion upon the sale if you own and occupy it for 2 years, 2 of the 5 years prior to selling the house. And
Mm,
if you're married and your spouse also meets those qualifications, you double that and get $500,000 exclusion. So a great way to reap the benefits of the appreciation on real estate while minimizing or potentially eliminating any taxes on that. One thing I do tell my clients too, though, is with real estate or any endeavor, look at the financial side first. Don't necessarily look at the taxes. That's a great
right.
benefit, but that shouldn't drive any of your decisions when it comes to real estate or any financial decisions.
That's right. That's kind of like the icing on the cake, right?
Yeah, yeah, yeah.
So I have a question here from one of my current or existing buyers or past clients.
Sure.
He said, more specifically the to an investment property, what are the tax benefits or what are the deduction? What's deductible on an
Sure.
investment property? I know you got the typical stuff like mortgage interest, but there's also like depreciation.
Mhm.
How does that work? Why does that work? I mean, a lot of
Sure.
people ask me about depreciation.
Sure, sure. With the rental property, you can deduct anything relating to the property. So not just your mortgage, interest, and property taxes, your insurance, your maintenance, everything that's relating to the property. But yeah, that insurance, the depreciation is a big, powerful tool with rental properties. So the IRS allows you to deduct the cost of the house over time. And so with a rental property, depending on the type, so for residential rental properties, you have 27 and a half years. And with commercial properties, it's 39 years. So you can take the cost of the house. You have to allocate part of it to land
Okay.
and then the rest to building. The building can be depreciated. The land is not depreciable. So the building piece you can deduct. So say you buy a rental house, the building portion you can deduct over 27 and a half years. So you just take that
Okay.
portion that you allocate to building and divide by 27 and a half years. So it's a great tool. I mean, if you have a property that's positively cash flowing, you could actually have a tax loss on that. So it's a great tool to have.
Oh, so okay, so let's just say that the house is worth $1 million today.
Mhm.
That's excluding the land,
Yeah.
just the building.
Mhm.
So you divide that $1 million by 27 and a half years, and that's the maximum you can depreciate
Yes,
per. What if
per year. Yeah.
what if you sell it?
So that does decrease your basis in the property. So when you do sell that, you actually have to kind of recoup that upon the sale. There's something called depreciation recapture, where you are recapturing that and paying the taxes on that during the life. So if you want to, we could do kind of a deep dive on that maybe in a future date. But
Wow.
there's a lot of intricacies to it. But in the while you're renting it out, it's actually a great tool to have.
Wow, that is interesting. So you have to think about how long you're going to keep that house.
Mhm.
If you're planning on selling within the first 15 years or the first 10 years, then you don't do that 27 and a half year.
Well, no. So the IRS code states that you must take that. So when you sell the property, you have to factor in that depreciation if you took it or not. So you
Okay,
might as well take it. Yeah.
got it, got
Yeah.
it. Wow. So along the same lines, do you see a benefit of placing that investment property into an LLC from a tax shelter perspective? I mean, does it benefit anything?
From a tax perspective, not necessarily. I mean, an
Okay.
LLC is generally we use those for liability protection,
Mhm.
but an LLC, especially a single member LLC, for federal tax purposes, it's considered a disregarded entity. And so actually it's going to get taxed exactly as if you owned it in your own name.
Okay.
So there isn't necessarily any tax benefit from owning it in the LLC. Really, the biggest benefit is that liability protection.
Got it. Got it.
Mm.
And I just remembered a customer just recently. He bought an investment property, $500,000 condo here in San Jose. He's
Hmm.
renting it out for $2,750 a month. Total payment is like 28.25. So I know he's negative, like
Hmm.
$75 cash flow.
Yeah.
But this is a question for you because I got to get back to him with this question.
Sure.
After factoring in all the tax deduction, including the depreciation, how negative would he actually be? Can you speak on that a little
Sure.
bit?
So in this situation, the depreciation would just add to their loss, right? So, but first you have to look at the full mortgage payment's not deductible. The principal paid only the interest portion. The principal is not deductible. So in this instance, he's probably about break even, I would say. So then that
Right.
depreciation, assuming no other deductions, that depreciation would just push him down negative by whatever the depreciation amount is. So say he was just purely break even for the whole year, on 400,000, that's about 14.5 in depreciation. So he should actually show a loss of 14,500.
Wow.
So yeah, and so if he can take that on the return will depend on some other factors,
Right.
but yeah, but he won't definitely won't have to pay taxes on this property.
Yeah, so he's earning about $180,000 a year. So
Okay.
he's W-2.
Mhm.
So that negative, now this is a question for you. We just keep going deeper on this.
Sure, sure.
So the does that $14,000 deduction, does that offset some of his W-2 taxes?
So in this instance, if he makes $180,000, he's over the threshold. Backtrack a little bit. Rental income or losses are considered passive activities,
Mhm.
and so there's a separate set of rules for passive income and losses versus active income. Active would be your W-2 income, business income, things like that. Passive income, the income is taxable, that doesn't change, but the losses are treated differently. So if your income is over $150,000, the income or the loss from any passive activity is not immediately deductible. It'll get carried forward until one of two things happens. Either your income falls below that 150 threshold, you may be able to take some or all of it, or you sell the related property. At that point, then it all becomes released, and you can take that full whatever was being suspended and carried forward.
Wow. That is pretty complex.
Yeah.
So it's very specific. Yeah, it's
Mhm.
very specific to the individual buyer or
Yes.
owner
Yes.
or investor.
Mhm.
You mentioned earlier that if you sell, you have to wait. Basically, my understanding is that you have to wait 2 years to sell that property in order to take advantage of that tax exemption. 250 for single, 500 for a
Mhm.
married couple.
Mhm.
Now, what if you didn't live there for 2 years and you decide or need to sell before that? Is there a way to defer those capital gain taxes? Is there a way around it, basically?
Yeah. So the exclusion is for your primary residence.
Hmm.
And so, yes, you do have to live in it for 2 years. There are some exceptions if you don't meet the 2 year requirements, so you need to move out in a year.
Hmm.
There are a few, like a change of job, a change of health, things like that, where that'll allow you to prorate the exclusion amount. So if you move out, say exactly a year after you bought it, and you have to move because of a change of employment,
Hmm.
then you could take half of the exclusion, so 125 each if
Wow.
you know, married. So that's one exception that you can have. There's that's very limited. You can't just move because you want to move and take half. There has to be a very specific reason,
Right.
but you can do that.
Okay.
For a rental property, you don't have that 120 or $250,000 exclusion since it's not your primary residence. So with that, you do have some other options. There's a 1031 exchange, which you need to exchange into a equal or more expensive property, or something relatively new is qualified opportunity zones, not necessarily relating to real estate, but a way to defer and minimize your capital gains is investing in a qualified opportunity zone.
Wow. This is great. So here's another one.
Sure.
Last one, promise. So you have $1 million in capital gains. You live in the property. You lived in the property for 5 years.
Sure.
You're married. You get that $500,000 exemption. What about the other $500,000 you're going to get taxed on?
Mhm.
Is there a way to defer, or is there a way to avoid that? this is your primary residence, so you can't do a
Yeah.
1031 exchange.
So unfortunately, no. I mean that you have that $500,000. There's no rolling it into anything else. So
All right.
the only thing you could possibly do is say move out and rent it for a year or two, and then 1031 exchange it.
Okay.
You lose that 500,000 though, because you know that 500,000 exclusion. But there's some things you can do to kind of avoid. You're not evading taxes. You're avoiding taxes, right? So there's some things you could do where you can convert it to a rental property, 1031 exchange it. Maybe down the line you could move back into it for a couple of years and then take advantage of that $500,000 exclusion at that point. But there are some strategies you can use. But if you're just moving out and want to sell after 2 years, then yeah, you're kind of stuck with that capital gain.
All
That'd be
right.
a nice capital gain after 2 years, though. $100
I
million.
know. Derek, I have dozens of questions here, but I know we're running out of time. So, is there anything else you would like to add?
Really just if you're thinking about buying or selling, just talk to your accountant. There's a lot of pitfalls that you can fall into when selling or buying a property. So really, you want to run the numbers, run your own numbers, make sure it makes sense for you, but talk to your accountant. Get those tax numbers and everything, and just make sure that it makes sense. Especially now with the increased standard deduction and the limit on property taxes. You may buy a house and find that you get very little or no benefit from buying the house. So, something that you were factoring in that was going to help you out may not actually be a help. So, talking to an accountant will really kind of clarify those things for you.
Right. I mean, we just discussed very simple scenarios and we went down that rabbit hole and it quickly got complex.
Sure.
So this is, you make an excellent point saying that you do need to contact an accountant to help you, somebody that specializes in this. Derek, this is all very nice. Thank you so much for all this tremendously valuable information.
Sure.
I really appreciate you for doing this. And I have placed your information in the description below. And your Instagram handle is DT Fujikawa,
Yes.
right? On Instagram. I already said it. So can they reach you through Instagram if they'd like to book an appointment for a consultation?
Sure. You can message me on Instagram. I'll put my email and website in the description below as well.
Perfect. Now I have to ask, because this is all tremendously valuable information, they're going to ask, is there a fee for the consultation? And if there is, how much is it?
For initial quick consultation, I don't charge. And then, hopefully moving forward, then, it would be at our current rates, which we can discuss.
Okay, perfect. I love it. Again, Derek, thank you so much. And I will talk to you soon.
Great. Thank you.
All right. Bye.
All right. Bye.